So, Lindsay, I was thinking, I need a couple extra bucks for this weekend.
Cool.
Yeah, I was just learning about tax credits in my Econ 445 class.
Okay, great.
There's something called child tax credit. Have you heard of it?
Of course I've heard of it. Look at my highlighting. It grants credit to families based on the number of dependent children they have and their income level. You may be able to reduce your federal income tax by up to $1,000 for each qualifying child under the age of 17.
So, basically what you're saying, I can make up to $1,000 if I have a kid? So, what do you say, Lindsay?
Men are such pigs.
What? You left all your stuff.
You guys are very fortunate to have a child tax credit that is being given to you in Dallas. In Ghana, where I am from, people give birth to children. A lot of them, they just give birth to children because they are honored when they give birth to 10 children. Therefore, they just give birth. Do you know what they give to them when they give birth to 10 children? A goat.
Daniel's Ghana cultural tradition of goat giving in reward for childbearing is not unlike the purpose behind the state's child tax credit. As reflected by what UD students clearly gather from the credit, it seems as though it creates an incentive to have kids. However, the credit is unlikely to have a significant impact on inducing families to have children. Moreover, it is very difficult to study the economic incentives behind childbearing, as the value of having children is mostly subjective, considering happiness and family fulfillment that children bring. While the credit reduces the cost of a child, the expenses incurred from children greatly exceed the credit for most taxpayers. Between medical bills, tuition, and childcare, it is very difficult to support a family and raise children, which will spur the future economy and keep the wealth of America growing. Luckily, the government offers generous tax breaks to help ease the financial burden, including the child tax credit.
The child tax credit is a tax credit designed to help offset the cost of raising a child. With the child tax credit, you may be able to reduce your federal income tax by up to $1,000 for each qualifying child under the age of 17. Taxpayers eligible for the credit subtracted from the total amount of federal income taxes they would otherwise owe. Here are the many qualification criteria for the CTC. The child tax credit, like other credits, is gradually reduced based on a person's income for the year. The child tax credit starts to be reduced when an income reaches the following levels: $55,000 for married couples filling separately, $75,000 for single, head of households, and qualifying widow or widowers, and $110,000 for married couples filling jointly.
Fundamentally, I see the child tax credit as another example of the way in which politicians are constantly trying to appeal to particular target parts of the population. In this class, people with children are a majority of the population. There's some logic to making them feel good about what's happening with the tax code. I think it would be better if we simplified the tax code to a particular degree. It's a little bit difficult when you can have two economists sitting there trying to figure out whether they've made mistakes on their income tax return. And so I constantly wonder what someone who might be less attuned to economics makes of those tax returns. So,
President Bush's 2005 presidential panel on federal tax reform summarized the complexity of the child tax credit. Figuring out whether you can claim a child tax credit requires the skills of a professional sleuth. You need to complete 8 lines on a tax form, perform up to 5 calculations, and fill out as many as 3 other forms. There are a number of credits in addition to the previously described child tax credit offered by the government, which includes child-related tax benefits. The Earned Income Tax Credit is a federal income tax that essentially helps you keep more of what you earned, and children are included in the credits, as they certainly require a serious outlay of your earnings. Dependent exemption reduces your taxable income by a fixed amount for each qualifying child in the family, and head of household allows you to claim this filing status if you are unmarried and have cared for a dependent for over a year and a half, and have paid for more than half of the cost of maintaining a home. This information directly from the IRS website are the qualifications for each child tax benefit. Experts believe that the different age qualifications and intense eligibility criteria among these child benefits make it increasingly difficult for taxpayers to claim the intended benefits. This administrative nightmare results in a direct financial cost to taxpayers if they hire a preparer. IRS states that more than half of taxpayers making less than $50,000 use paid tax preparers, an expensive necessity. As we have seen, much of the complexity of the child benefits is relating to differing definitions of what constitutes an eligible child, specifically the different age limits, as captured on the IRS website, of qualifying children among different tax credits. Beyond differing definitions of what constitutes an eligible child, the child tax benefits themselves are each structured differently. The interaction of these different structures has led to middle-income families receiving a smaller total benefit than some higher-income taxpayers, as illustrated in this graph, which we know is not the sole intention of the child tax credit. We propose reducing the complexity of these provisions and making their benefit more transparent by combining the child tax benefit into a uniform child credit. However, the competing functions of the specific credits need to be accounted for and written into the uniform policy. For example, as we described earlier, the main purpose of the child credit is relief to parents for bearing and raising children. In particular, the child tax credit targeted lower-income families, while on the other hand, the dependent exemption benefits flow mostly to families with relatively high incomes. This must be accounted for. We would recommend applying a uniform age of under 19 years old that holds under its umbrella the CTC, the EITC, dependent exemption, and head of household filing status. This change would significantly improve the provisions and simplify their administration. Imposing this age would expand population eligible for the child tax credit by allowing 17 and 18-year-olds, the age that mimics the end of childhood and start of the voting rights age, and would contract the population eligible for the EITC by making students between 19 and 23 ineligible. Savings from those changes, an estimated $900 million, could be used to expand college assistance, making the total proposal revenue neutral. As reflected in the graph, all the proposal's credit increases would be attributable to increase in age of eligibility of the CTC from 17 to 18. The benefits would be concentrated on families with income less than $75K, single parents, or $110K, married parents. At that point, the credit begins to phase out at a rate of 5 cents for every additional dollar of income. A little more than 50% of the benefits of the proposal would be delivered to families with income between 10 and 50K, capturing most families below the poverty line. Families with higher incomes will not benefit from the EITC or CTC, which targeted lower income families in the first place, but benefit more from the dependent exemption and head of household filing status than their lower income peers, which were those credits' purpose. Essentially, though, the policy would make families eligible for an additional 2 years of the child tax credit, for which almost all children and families with income below the threshold qualify, indicating that the low-income families would benefit most from our proposal, aligning with the original intentions behind the credit. Overall, our proposal would have a smoothing effect, increasing equality and incentives to have children over all income brackets. It also relieves the call for separating work and child incentives. Limiting child incentives to those under the age of 19 would let reformers choose how to responsibly divide national spending between children and worker benefits. This would allow taxpayers to better understand and react to incentives. Our proposal addresses the problem of inconsistent age among credits by unifying the age and child criteria of eligibility and then separating out work from child incentives. Aligning the CTC rules with other related tax provisions seems to be more sensible for taxpayers and a prudent step towards budgetary responsibility.